Well, it's a highly fragmented industry. And so if you think about it this way, of the publicly traded miners, all of the publicly traded miners in the US together represent less than 25% of the global hash rate. You have a number of Bitcoin miners at the sovereign level around the world. You have many private miners. 21% of mining is still done in China. But no miners are really bigger than, some of the biggest miners are maybe 2%, something like that. And there are just, many, many, many people who mine. And one of the beauties of the Bitcoin blockchain is that it's so decentralized.
Welcome to a new episode of Bitcoin Equity Talks. Today I'm with Fred Thiel, the CEO of Marathon Digital Holding. It's our biggest holding also in our ETF, which is a Bitcoin equities ETF, and Marathon is about 10% of our portfolio. It is the number one of the 30 stocks that we hold in Bitcoin equities in general. So I'd like to jump into it, ask you to present yourself and present a little bit of background for our European investors that are maybe less familiar with Marathon Digital Holdings and your history and your positioning in the Bitcoin mining space.
Sure. So my name's Fred Thiel. I'm chairman and CEO of Marathon Digital Holdings. Marathon started in the Bitcoin mining space in about 2017 at a very small scale and grew its capacity modestly through about 2020 when the company raised a considerable amount of money using at-the-money offerings on the NASDAQ and placed an order for about 70,000 mining rigs, which at the time was probably one of the single largest orders ever placed with Bitmain, who is the primary hardware vendor in the space for miners in the industry. And then began deploying miners at scale. And today we are at 23 exahash of capacity, running nearly 200,000 miners. And we are the largest publicly traded Bitcoin miner in the world globally. We have mining operations in Texas, North Dakota, and we recently started mining in a joint venture together with the sovereign in the United Arab Emirates in Abu Dhabi. And we continue to explore other opportunities in areas such as Asia, Africa, and also US and Latin America.
Okay, awesome. So just for me to understand, you're the largest publicly listed Bitcoin miner, yet reading your latest announcements, you said you represent around 3% the Bitcoin mining capacity or hash rate production. How come you being the biggest, but still very small in percentage compared to the overall Bitcoin mining industry?
Well, it's a highly fragmented industry. And so if you think about it this way, of the publicly traded miners, all of the publicly traded miners in the US together represent less than 25% of the global hash rate. You have a number of Bitcoin miners at the sovereign level around the world. You have many private miners. 21% of mining is still done in China. But no miners are really bigger than, some of the biggest miners are maybe 2%, something like that. And there are just, many, many, many people who mine. And one of the beauties of the Bitcoin blockchain is that it's so decentralized.
Okay, so because there were some worries that was like 5 or 10 years ago about the concentration of the Bitcoin miners in very little hands. But as time went by, it seemed that this consolidation didn't occur. What's your vision on the long-term evolution of this distribution of Bitcoin miners? Shall we see consolidation or continuous fragmentation?
I think over time you'll see some consolidation, but the industry is very wary of any one miner having more than, say, 15% of the global hash rate. Because if you're at 15%, then you acquire another big miner, and now you're starting to get close to the magical 51%, which is the level at which people really start to worry about concentration risk. So I think what you'll tend to find is miners will consolidate. You'll have a number of players that are at the 10% level, and then you may have one player who's at 15%. But over time, mining becomes a business which is really very institutional or industrial at scale. you really need to be able to operate with very low energy prices at very large scale, because every 4 years are reduced by 50%. So the block subsidies, which is essentially what covers our costs to operate, which are paid by the Bitcoin blockchain, every 4 years, those are reduced by 50%. And next year, in the late spring, is the next occurrence of that. And then in 2028 is the next occurrence again after that, and so on until the last Bitcoin has been mined, at which point Bitcoin miners to operate the Bitcoin blockchain will be paid solely based on transaction fees. And there are times when transaction fees are equal to or greater than the block subsidy, which is great. But for the most part, transaction fees tend to represent less than 10% of the revenues of Bitcoin miners. And so unless the price of Bitcoin continues to move up greatly, you'll tend to find that the smaller scale miners just won't be able to afford to remain in the business, both because their cost to mine will be too high for them to be competitive, and they won't have the ability to reinvest in the next generation technologies that will make them more energy efficient and more lower cost producers.
You jumped into the Bitcoin halving, but that was my next question. So how do you see the Bitcoin mining space evolving post the Bitcoin halving that is going to occur in March 2024, if I'm not correct?
April 2024. So what's going to happen is that you're going to have to look at the energy efficiency of the fleets of the miners that are running. The average energy efficiency, meaning how much energy does it take for a miner to generate 1 terahash of compute power, is about 33 joules or watts per terahash. If you look at Marathon's fleet, our fleet is between 24 and 25 joules per terahash, which is much more energy efficient than the general fleet. So typically at a halving like this, more than likely, 50% of the fleet that is somewhere higher than 28, 29 joules per terahash will just have to shut down because they won't be economically viable at that point.
Okay, I see. So, and how do you position yourself on the energy efficiency level? I haven't seen any sort of official communication on your part about your average electricity price, unless I missed something. But how do you compare yourself to other miners?
So we don't publish electricity price because many of our deals are electricity and hosting in one price. And so we don't break out electricity per se, because in many cases, we don't have a direct PPA. We're paying an all-in-one price, if you would. But if you look at the energy prices that we have been paying historically, they're somewhere in the 3 to 3.5 cents a kilowatt hour price, sometimes up to 4 and location, which is very competitive.
Okay. I've also seen like a big spike in your Bitcoin production. Any reason why recently there was a spike there?
Well, part of it is we've increased since the end of last year, we've tripled our capacity to mine Bitcoin. So we've increased it threefold. We've increased the efficiency of it, meaning we have higher uptime and it's producing better. And we've launched our fully vertically integrated technology stack, which instead of using a third-party pool for orchestration and instead of using standard firmware in the miners, we run a custom version of our own firmware in the miners. We have our own proprietary pool. We run our own immersion technology. All of these in our processes, which mean that we can produce a little bit more Bitcoin than the average person.
Okay, I see. Looking also at your balance sheet and financial structure, I saw that you're holding a big amount of debt. We saw last year in 2022, some miners who suffered because of that, and some of them went bust. How do you cope with the volatile assets while managing your debt, basically? What's the logic behind it, and how do you see it on the long run?
Well, Marathon has no current debt. The only debt we have is a convertible bond that doesn't come due until end of 2026. There's a 1% coupon on it, which is very affordable, and there's no amortization on it. So that's not a problem, definitely in the short term.
Okay. And on the long term, do you think that the current capital structure is the ideal one, or you see it evolving towards maybe more convertibles or less? Or how do you see what is the ideal capital structure?
Well, the ideal structure changes with the environment for logical reasons, right? If Bitcoin price is running way ahead and it's very high profitability, then debt can be very easily serviced and people should be able to get debt easily and capital should be easy to get. In today's environment, capital is very hard to get and debt is very hard to get. The debt that we carry at with a 1% carrying cost, the interest, in other words, we pay, you can't find debt at that level today. So if anything, over time, that debt will likely be reduced. There's no reason in today's environment to carry any debt if you can. We have the benefit that we have a lot of liquidity in our stock. We have a lot of stock available that we can use to pay down debt if we wanted to do that. I don't necessarily think that paying down debt at par today would make sense. But, there are opportunities to potentially, buy back a portion of the debt at a steep discount. Who knows?
Also looking at your balance sheet, I see a significant amount of Bitcoins held over there. What's the logic behind it? Because on this strategy, miners tend to hedge everything or sell everything straight out of productions. Others tend to keep. What portion of your profits do you invest, or what portion of your produced Bitcoins do you keep and which ones do you sell?
So we operate very much like an oil company would, which is, we extract Bitcoin through our process. We sell enough Bitcoin to cover our operating expenses, so we're not diluting our shareholders or incurring debt to cover our operating expenses. And then anything that remains, we keep in Bitcoin.
So because contrary to oil companies or gold companies or any commodity companies, you never see like a significant stock of the commodity on the balance sheet of the company.
Well, that's not really true because oil companies sit on reserves, which is simply oil they haven't pumped out of the ground. So whether it's out in the ground or whether it's in a tank outside of the ground, it has the same value. So oil companies do carry reserves. In Bitcoin, that phenomenon doesn't exist. And so you have to carry it as an asset post-mining because it's a fee essentially we earn for doing what we do. Some miners have to sell all the Bitcoin they mine because they have no way to buy new machines. They can't raise equity. They don't have a liquid stock. They're not debt worthy. And luckily we're not in that situation. So from our perspective, we don't want to dilute our shareholders for operating expenses. But by any person's analysis, if you look at the value on a per share basis of our Bitcoin, which the Bitcoin holdings in our balance sheet today are, north of $300 and some odd million on the balance sheet today, unencumbered. The shareholder equity that provides, the value to our shareholders is significant. And if the price of Bitcoin moves upwards 10, 15%, it's a much better investment for us to hold that Bitcoin than to have that as fiat currency, which is only losing value every day by 5, 6% a year, right? So, and if you look at this year, the price of Bitcoin has gone up by, over 100% almost this year. So it's been very good for us to hold the Bitcoin.
Okay, I got it. What about valuation? Since you talked about it, how should one look at valuing a Bitcoin mining company? Because it's models. If one wants to look at a comparative valuation to listed Bitcoin miners, what kind of methods do you recommend?
Well, it's very complex because you need to understand the age of their plant, property, and equipment assets, which also has to do with the energy efficiency of them. So, for example, one miner may have bought mining rigs 5 years ago. They're now fully paid for, but the problem is they have very poor energy efficiency because they were purchased 5 years ago. And the technology moves so quickly in this industry that you really have to have the latest and the greatest miners. And for example, Marathon's fleet is the most advanced fleet in the world today. We have a higher percentage of the fastest and most energy efficient machines than any other miner does because of how we purchased machines over the past 2 years. The other thing you need to look at is obviously balance sheet. How much debt do they carry? How profitable are they? How many employees? What's the productivity per employee? Marathon has under 50 employees. Most of our competitors have hundreds of employees. So we're hugely efficient from a headcount perspective. Plus, we have a lot of diversification in our mining operations. Most miners operate out of one or two locations, typically in the same state, in the same location. Riot, for example, who's also a very large miner, all of their mining happens in an area of Texas that's within 100 miles of Austin, Texas. So they are at risk for Texas changing a law, a rule, US government changing a taxation law, all sorts of risks. Marathon mines in Texas. We also mine in North Dakota. We also mine in the United Arab Emirates. And we're going to continue to diversify our locations that we mine in so that we don't have concentration risk in our business. I spent a number of years working in the private equity industry. And for me, we really focus at Marathon on generating shareholder value, which is for us a combination of strategic value and also risk mitigation. And we mitigate risks through having multiple partners we work with, both on the capital side and on the hosting and energy side and on the equipment side. We locate in different locations, so we're not subject to any one utility company or utility grids foibles, different states, different countries, and we'll continue to diversify geographically on a global basis as well. And we also diversify in how we operate our sites. Some sites we operate from the ground up, meaning we designed the site, we built it, we spec'd it, we did a contract with the power provider directly, and we operate the site. Other sites are fully third-party hands-off. You need to use different models depending on what's going on in the industry. When the price of Bitcoin is growing rapidly, then third-party hosting is very attractive because it lets you scale very quickly. There would be no way that we could have scaled to triple our size at the end of last year by middle of this year had we only been building our own sites. That would have been very difficult to do. So you have to look at the Bitcoin industry as something that goes through a 4-year cycle. There are 2 great years, there are 2 tough years, and you have to be able to do your acquisitions of machines and things in the tough years when people don't have access to capital and there's less competition, the prices drop. In the good years, when everything is expanding and everybody has money, machines become more expensive, sites become harder to find, and it becomes more competitive. The global hash rate grows. So you have to really time what you're doing, and you have to make sure you're maintaining full optionality. And we're very focused on always making sure that our balance sheet is structured so that we have the ability to go raise equity, raise debt, whatever we need to do at any given time so we can move quickly as opportunities present themselves. And having that full optionality, we think, is a clear differentiator. Plus, just from a strategic value creation perspective, the technology stack that we've built from, you can kind of liken it to Apple, who has cloud all the way down to ASICs. We have a similar concept from our cloud solution at the pool all the way down to the ASICs and the miners, where we co-invested with some of the top VCs in Silicon Valley in a company called Auradine that makes one of the top miners in the industry today based on our testing and analysis. We have the ability to fully control that technology stack. No other miner has that. And what does that mean? Well, it means that we become an extremely attractive partner to sovereigns, which is one of the reasons we were able to do the deal that we did in UAE with the sovereign there, because we have a fully integrated solution that we control. And it diminishes risk for them because they can get a fully integrated solution. And as we continue to look, as this industry matures, more and more people may be interested in buying our technologies, which then creates another revenue stream for us. And so we believe that our technology is a strategic asset that adds to our value to our shareholders.
You mentioned the Emirates. That's quite new or out of the box, I would say, because I haven't seen any listed Bitcoin miner going into this location. Can you tell us a little bit more about this location and how come you're the only one there?
Sure. So obviously the sovereign controls who gets to mine there or not. They had done a number of tests with different parties, and those tests had not delivered the results that were expected. We began speaking to them late last year, and we set up a pilot where we were able to run that very successfully. The UAE is an environment where it's extremely hot and very humid. The ambient temperature is north of 40 degrees centigrade on most days during the summer and kind of half the year at least, and which is an environment that miners typically don't run very well in. But we had designed an immersion technology where the miners literally sit in fluid that's dielectric, non-conductive. And our pilot ran for over 100 days before an engineer had to go on site and touch anything, which was a huge success. And so we signed a JV agreement with the sovereign in February of this year, so just a few months ago. And the first site was already operational by the end of July of this year. So we'll have 250 megawatts or roughly 7 exahash, which is the equivalent of all the capacity we had running as of the end of last year, running just in UAE by the end of this year.
Okay, Ron. Maybe one word about comparing an investment in Marathon Digital Holdings versus a direct Bitcoin holding. So
Sure.
why should one buy Bitcoin or buy your stock? And how do you see it? Because at the end you are holding some Bitcoin. So which one do you advise?
So, I obviously advise holding Marathon stock because I'm a large shareholder of the company and I want other people to invest in our stock.
Yeah,
but similar to Warren.
That's a biased opinion, but
I understand. Well, so what you need to do is you need to look at how does our stock perform compared to Bitcoin? There's a lot more volatility in our stock than there is in Bitcoin. So if Bitcoin moves 2-3%, we'll move 10%. So what does that do? It provides a huge advantage to people who like to trade the stock. And so this is the same reason that Warren Buffett has famously said that he doesn't buy gold, but he buys gold miner stocks because they move with greater beta than the underlying commodity. Why is that? Well, it's because they actually mine the underlying commodity at a discount to the spot market price, right? That's something you have to realize that. And by holding it, you get the exposure to Bitcoin because of the Bitcoin we have in our balance sheet, but you also get the exposure to the margin that we generate by being a miner. And so I think it's very easy. Just go look at how much our stock has performed compared to Bitcoin. Bitcoin is up 100% this year. Our stock is up, it's been over 300% up this year at one point recently. I think now we're down at about 270%. But, we've outperformed Bitcoin by 2 to 1.
But that is beta. What about alpha?
Like I said, we outperformed Bitcoin 2 to 1 this year so far. So there's beta, but in raw alpha, we've given our shareholders more alpha than Bitcoin.
Okay. Perhaps one word about sustainability. What would you say to someone who says you're just by mining Bitcoin, which is a useless digital?
I suggest they read reports by people like KPMG and others who have put out reports that show how mining Bitcoin balances the electricity grid. The other thing is, 58% of the energy we use to mine Bitcoin is sustainable, renewable energy. So no other industry is as sustainable as Bitcoin mining. You look at the banking industry, which uses much more energy just to power ATM networks, most of which is carbon-based. So I think, it's very easy to sit somebody down and walk through the reasons why, Bitcoin uses predominantly renewable energy sources, B, Bitcoin helps balance the grids because, and this is one of the key reasons the sovereign in UAE wanted to see Bitcoin mining there, is they have an energy imbalance. In the summertime, they have to generate 4 gigawatts of power to run all the cooling and all their water desal. And in the wintertime, they only need 1 gigawatt, but they still need to run the energy for the water desal. So if you have a baseload customer like a Bitcoin miner that can shut off their systems in 10 minutes and then bring them back up in 10 minutes, it's very easy to balance the grid. 95% of people have no concept of how an energy grid operates. They just think that people generate electricity and it's always going to come out of the plug in the wall. What they don't realize is the grid can't hold energy. It's not a battery. They have to tell the generators to shut off if people aren't using electricity, and people don't use a constant amount of electricity during the day. The utilization of energy from the grid varies hour by hour every day, and it's different every day. And so the grid and the utility operators are constantly balancing with the energy generators, telling them turn down, turn up, turn down, turn up. And that's a very difficult process. You can't do that with nuclear power plants. You can't do it with coal plants. You can do it with some natural gas-fired plants. With solar and wind plants, they are intermittent, meaning the sun doesn't shine 24 hours and the wind doesn't blow 24 hours a day. So they need a customer that can essentially shed load instantly when they need it, and who can, when they need it to be consumed again, can consume that load. And Bitcoin miners fit that perfectly. We are much better than batteries for the grid. And that's why if you talk to the grid operators in Texas, they love us. If you were to go talk to the grid operator in UAE, they love us. It's because we provide balance to the grid in a way that nobody else can.
Okay. You talk about load balancing. So shouldn't this whole Bitcoin mining activity be done by energy producers instead of niche Bitcoin miners, because they are the ones who have the most energy?
Well, they would also have to be spending all of the capital to do it. Think about it. If you're an energy producer and you can invite a Bitcoin miner to spend lots of money to build out all sorts of infrastructure to do what they have to do, and you get all the benefits of it without having to invest a penny, that's a pretty good deal. If you think about it, energy producers could deploy a lot of capital to batteries, but it's hugely expensive and it doesn't give them 24-hour coverage. It's the same reason with Bitcoin mining. It's better to have somebody else take all of the risk, both capital and regulatory perspective, than the energy companies. Energy companies think in 20, 30-year cycles. They don't think in 5-year cycles. And so Bitcoin is, eventually, and I've spoken publicly about this, eventually energy companies will get into this business. But today it's still a little too early.
Okay. Thanks a lot for your time. I'm not going to hold longer during the month of August, that is a quite light month. I'd be happy to jump on another call after your next quarter. So I'll give you an appointment for next time.
Perfect. Look forward to it.